Medical Properties Trust, Inc. is a healthcare REIT that owns hospitals in their property sector and has produced a very consistent history of producing consistent funds from operations growth, which is how you judge a REIT. The stock price has traditionally followed that growth until 2022. And this is a classic example of how sentiment can have such an impact on short-term performance, but at the same time, fundamentals are king when it comes to the long term. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And a highly requested stock that I've been asked to cover is Medical Properties REIT. And, I kind of focus on dividend-paying stocks and, to a lesser extent, real estate investment trusts. I do like them and I do use them actually sparingly in my portfolios because I typically like the classic dividend growth stock instead, simply because I know more about them. But Medical Properties Trust is either the income investor's dream or nightmare. And what I'm going to try to do with this video is help you sort out which is the case. Is this a dream stock for income investors to own, or it is a nightmare? So let's go ahead and get into FastGraphs and look at the company historically. Now, number one, I'm going to take price off the graph here for a moment, and I'm going to take the normal PE off. You can see that funds from operations have been consistent, and they've been growing at about 5.87%. If I shorten this time frame a little bit, since 2011, they've actually grown at 7.68%. And if I shorten it once again, it maintains a 7.68% growth. So for REITs, it's a relatively high rate of growth. Now, the fundamentals have been consistent. If I look at their analyst scorecard, they actually have a very good analyst scorecard. 2009, 10, and 11, they did miss estimates, but it wasn't really that horrible a miss. They stayed profitable. They generated FFO, but they didn't grow. That was coming out of course, the Great Recession, as I like to call it. So the only time they really missed estimates was during those, really troubled times. Now, since then, since 2011 forward, as I pointed out, they have almost a perfect record of hitting the analyst estimates. And I think that's very important because something that I want to go over, the analysts are currently looking at the company to have a rather weak year this year. They're having some trouble with Steward, one of their, a company that represents 30% of their revenues, where they've had some, financial trouble, but actually Medical Properties has been helping them, providing them financing. And there are analysts that believe that that's one of the real strengths, that Medical Properties has the flexibility to be able to do that. But the point I'm getting at is that this year we're expecting a negative growth rate, and next year a rather weak year. And then we expect them to start growing again a little bit in 2024. But the point is, the price has gotten so low. You can see that the stock price has fallen dramatically this year, from a high of 24 down to a current value of around 10. Now, the stock is actually showing some strength today. If we get a quote on it, it was up about as high as 5% early in the day. It's up about 4%. That's after being down rather strong. As you can see, it was down 5% yesterday. So we're starting to see some recovery. And the rationale for that recovery, which I'll get into a little bit later in the presentation, comes from the fact that they have reported that they're going to have a pretty strong buyback. And, they're going to talk about they authorized $500 million of buybacks, stock buybacks. And I think that's very good. Now, again, I'll get into that a little bit in the future. But the risk of owning this stock, to me, these estimates have stayed the same. I've double-checked with FactSet. There's been no change in these estimates. It is for rather, some weak numbers for the year, but relative to the current stock price, as they like to say on Wall Street, I believe the risk is already priced in. So in other words, purchasing this stock today at 10 makes a great deal of sense. Now, a real quick check of other sources, for example, Morningstar. Morningstar currently gives it 5 stars. And their 5-star price is 11.72, and the stock is trading at 10, or it was, as of yesterday. It's up a little bit today. They give it a fair value of 19.68. I think the fair value of this company is probably closer to 22 or 23. Now, if I use the normal multiple, I still get a number of, 22 something. So I do believe this is a very inexpensive stock. It currently yields over 11%, which is phenomenal. Now, it's only a BB plus credit rating, and the company does have 53% debt, but remember, they use debt to purchase properties and generate revenue. So we're going to take a look at this company more holistically here in a moment, but FFO growth has been good. The key is that price has typically followed that, and again, it did it at a relatively lower multiple, maybe 12.5 to 13 times earnings, but you can see there's many times where it traded at 15 times FFO, etc. And right now we've got it trading at a blended price to FFO of under 6, and I consider this to be an opportunity of a lifetime. If this were to just simply go back to its normal FFO, that would be a possibility of having an annualized, now not a total return, but an annualized rate of return of over 51%, almost 52% between now and the end of 2024, and that would be more than doubling its value. So there's a lot of reasons to take a look at this stock if you're an income investor. Until these estimates begin to change, I really don't see any issues with buying the stock today. Now, the historical growth rate of the company, has been much higher. And if I look at the forecast long-term growth of the company by the analysts at FactSet, they're looking at 5.43%. So let's go into the custom calculator and let's draw the current estimates in, because that's where the weakness is. And then, bring it out. Now, at 12 times earnings, this would be a 25% annualized rate of return over the next 5 years or so. At what would I consider to be a fair value PE, that would represent about a 29%. That's notwithstanding some weakness in the next couple of years here, where you could see, growth is expected to be come in at 4% this year, followed by 0.5% next year and 1.5% or a little more before it starts growing at 5% or more. Now, interestingly or not, if I check other estimate sources like Yahoo, if I look at what Yahoo thinks the next 5-year growth is going to be, they're expecting 9.8%. So analysts generally are, looking at this company to be, relatively attractive. So if I put, the custom in here of 9.8, I'll just round it to 10 and draw this at a 10% growth going forward, then those numbers, ratchet up to in the 30% range. And then even the normal PE of 12 would be over 25% annualized returns. So there's a lot of upside, assuming these fundamentals come into play. And it looks to me like, the FFO is expected to continue to grow. And then AFFO, or adjusted funds from operations, which is not quite as standardized, really gives us almost the identical picture itself. The analysts are still forecasting, about the same growth rates for adjusted FFO as we see for FFO itself. So we're still looking at some, pretty good numbers here. And we've got an extremely cheap stock with a double-digit dividend yield that's well protected. It doesn't look like the company is going to, has any real chance at this point of defaulting or cutting that dividend, but they have cut it in the past, and it's something you should be aware of. So let's go into the financials, and let's go to our fiscal fitness check here, and let's run it through, some metrics. I'm going to go through the last 8 years here or so. Going back to 2013, I could actually go 10 years, I think would be fine. And I want you to notice that since 2012, their free cash flow to equity has been, on par, giving them room to cover the dividends. Their operating cash flow growth has been about 6.7%. Now, share buybacks, the company has actually been issuing shares, which is very common for a REIT, and the stock price has been relatively high. Well, for the first time now, I want to remind you, they've just authorized a 500 million share buyback. Now, I like that when you're looking at the company currently with, such a low valuation. I think that, buying back stock, this is operating earnings, which don't work with REITs. Buying back stock when the price is this low, I believe is really good stewardship on the part of management. So I'm actually liking that. Sales revenue for this company has been growing beautifully at over 25% a year, and that's really continuing. Net income likewise has grown, with one misstep in 2014, at a rate of about 40% a year. But again, there's some really remarkable years. If I shorten this time frame, like the last 5 years, we get about a 23% growth rate with a big surge in 2018. Debt to equity has been about normal. Looking at the company's margins, they're actually doing better margins. The black line here represents industry norms. So they've got better operating margins and better net margins in the industry at large. Their asset turnover is not, great, but this is a REIT. The asset turnover is not really a good metric. The return on assets, however, is at par, actually exceeding, their industry standard. The return on equity is also above industry standard. And their return on invested capital is, pretty good at over 5%. So all in all, the company looks reasonably healthy. Now, as a FastGraph subscriber, you can also go into their financials and go through their financials, which I'm not going to do for sake of brevity again in this video. But I do want to point out you have that ability with FastGraphs. So in summary, I believe this company looks extremely undervalued. I think there's a lot of panic here. To me, this is a classic case of Warren Buffett, his advice where he said, be greedy when others are fearful and fearful when others are greedy. And now it looks like a time to be greedy on this stock if you're an income investor. One thing about bear markets, they create opportunities. Now, you saw that medical properties came into the COVID pandemic, which is designated by this gray area here with a very high valuation. The stock price crashed, and that would have been a terrific time to buy the stock. I also want to point out that with the Great Recession of 2008, had you bought the stock then, the price to AFFO got under 3. It's currently around, 7 if you're looking at AFFO. But even then, if you'd have bought the stock at that low valuation and held it even after, this low, unbelievably low value that the stock is currently trading at, you'd have still averaged over 14 or 15% a year. If you'd have bought it at this low and it traded at normal valuations or somewhat normal, you could be making 18 or 19% a year. The key to investing success is to buy low and sell high. And right now, it looks like Medical Properties Trust is giving you an opportunity to buy it at an extremely low valuation. As they say, no guts, no glory. If you're ever going to invest in this REIT and you're looking for an 11% yield, to me, it looks, very well covered by their cash flows. I think this company is worth taking a look if you're an income investor. It's a little bit speculative because of some of the news, but I also, recommend going into external links and going into the company, go into investor relations, and go into webcasts and presentations, and you can look at their August investor update, and you can get a lot of information. There's also, if you go into external links, that's one of the beauties of FastGraph. It gives you the ability, to research stocks deeper and faster. There's an excellent article in the Wall Street Journal. It's a little dated here. It was done in June 18th. Hospital Chain Gets Help was the title of the article, and it talks about their major tenant, Steward, and it talks about all the things that the company is doing. Now, there are analysts like Raymond James has come out, their analyst has come out and said that he believes that, the company has got the flexibility and the ability to go ahead and help their tenants. Steward does represent 30% of their revenues, but I do believe that, they look like they're going to survive, and Medical Properties is doing some other things. They just sold some property. They sold 3 Connecticut hospitals for $457 million on October 6th, so they've raised a little money. They're going to be buying back their stock. That's going to be a really excellent opportunity. I do believe their dividend is well covered, so you might want to take a closer look. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, saying thanks for watching. I hope you enjoyed this video. It was a requested stock, I might add, but I do have a very small position in Medical Properties Trust, and I do plan on adding to it in the future. I've still got some research that I'd like to do. So if you like the video, give me a like, ring the bell, subscribe to the channel, and take a look at FastGraphs. What a wonderful investment tool. The fundamentals here look like they're holding up on this company I covered today. And if the fundamentals are holding up and the price is low, that spells opportunity. Thanks for watching.